This is the second part in a series addressing the challenges that entrepreneurs will face in 2010. We learned in 2009 that investors are not likely to invest in the early phases of a company. Early phase is defined as the idea phase, the beta phase, or the prototype phase. So that means that entrepreneurs will have to fund the early phases of their company in 2010. There are some things to take into consideration given this reality. First of all, an entrepreneur needs to be psychologically prepared for that. They need to be prepared for the fact that there are no white knights that are going to come in and going to invest in this stage in that stage of their company, and need to make a plan going forward given that reality. Secondly, the likelihood of friends or family investing is also diminished in 2010. Friends and families' portfolios have been impacted in 2009, their savings rate, and the level of risk that they're willing to take in investments. So, how much money do you actually need to start a company? Surprisingly enough, it usually takes a lot more than an entrepreneur initially thinks it will take. So, you need to plan by using a business plan to determine how much expenditure is going to be required to get to that first prototype or get to that first level of customer acquisition, first series of revenue. And the plan is extremely important to prepare. Even though this is the experimental phase of the company, an early phase, it's good to prepare a plan so that you can determine where you stand in terms of the goals and objectives that you set in terms of the plan. Know your limits. Many entrepreneurs are very, very enthusiastic about their companies and are willing to put 150% into a company. But you need to be careful with that. And there are two areas that you should set limits on. One is the financial limit, and one is your personal time investment. On the financial side, you shouldn't invest all of your money and therefore have no money for personal items or potentially even for a second business. And on the other side of it is the amount of time you invest and emotional energy you invest. Startup companies are extremely challenging from a time perspective and energy investment. And if you're not really careful, this could have a big impact on your relationships and also your family. So put that in check and make sure you have enough in reserves to spread out amongst other people within your network. Early investor commitment. Even though investors are highly unlikely to invest in the early stages of companies in 2010, you should still consult with investors during that early phase. The goal of the consultation is to determine if the business you are proposing is of any interest to investors, such that if you get to a point where you have developed a prototype, or you have developed a beta product, or you have some customers coming to your site and you have some revenue, will an investor actually invest in the company at that stage? If they are not interested in your business, even if you have reached those milestones, then you should seriously consider not launching that business or investing in that business. However, if they are in fact interested, this is a great support for the business, and it sets a goal for you that at a certain point in time, within a certain amount of money invested, an investor will invest. Spread financial risk. Startup companies from a financial perspective are extremely challenging. And no single individual should take on that risk exclusively by themselves. You should spread it out, obviously to gain more investment within the business, but also it's a psychological has a psychological impact as well, because other individuals in the business will share ideas, they'll have good creative ideas. So in addition to funding, they may bring some great ideas to the company that will make it a success. Get family buy-in. Even though you are the one starting the business, the reality is, given the time and money invested, the family will be invested in the business, however you define family. and they must have the same level of commitment and understanding of the business as you do. If they don't, if you move forward and you don't consult with them, then it could have some interesting impact on your family. So please consult your family before stepping into the entrepreneur start a business phase. Live to fight another day. Unfortunately, most initial businesses that entrepreneurs start are not a success, at least from a business perspective. But that doesn't necessarily mean that there's not value add for participating in that exercise. Many entrepreneurs go on later in life starting second and third businesses that are in fact extremely successful, and the reason for that is that they've learned some really valuable lessons within their first business. So in conclusion, 2010 is going to be a challenging year from an investment perspective, which will most likely require entrepreneurs to invest in the early phases of their company. During this period, when you're investing in the early phases of your company, you should consult with an investor, even though they may not invest in that stage, to make sure that in fact that if the company reaches certain milestones, then an investor will in fact invest.